This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today in the show, I have Ewan Kirk. He's the head of Cantab Capital in Cambridge, in the UK. Ewan brings very clear and strong opinions. I'm sure there's probably a few things that he says in this interview that will be enlightening, and perhaps a few people will feel like their feathers are ruffled. But nonetheless, I love it. What a great story from 2006 to today. Growing his assets under management from around 30 million to over 5 billion. Inspiration as well. Ewan has seen his net worth climb from not super high to super high. I think super high, a $500 million plus would be quite inspirational. A trend following trader plus other strategies, but clearly a trend following foundation. One thing to keep in mind also, September of 2014, for all of the last couple years where you'd read these articles, is trend following dead? Is trend following dead? Trend following's over. September 2014 comes along and boom. It's not about consistent profits. Consistent profits, predictable profits are the Holy Grail. You're never going to get there. Better to have a strategy that takes those small losses and then finds those big months, those big periods where the world changes, where profits come unexpectedly. That's trend following. I hope you enjoy this conversation. And if you'll indulge me for a moment, I would love to go back in time a little bit. And I'd love for you to paint the picture, because we're going to break apart your trading strategy, your management strategy. I want to break all that apart. But before that, a guy with a PhD in mathematical physics going to Goldman Sachs, you weren't the guy that was living and breathing trading when you got there, were you?
Not at all, no. When I turned up for my first interview at Goldman Sachs in 1992, I didn't actually know who Goldman Sachs were. I thought that they were a bank, but apart from that, I wasn't entirely sure. So no, I didn't live or breathe trading. I didn't even live or breathe quantitative finance. Probably couldn't have discounted the cash flow.
So they were looking for a certain type of thinker, a certain type of thinking.
Yes, they were looking for somebody who had some sort of mathematical background, and computer programming is also important. I say this to just about everybody that we interview, that it's sort of useless being a mathematician, being a statistician without being able to computer program, or without being able to program a computer rather, because it's like being a novelist who can't write. The way that you express your views or express your ideas is through programming computers. And so I was a reasonably good computer programmer. I had a background in quant, and Goldman very kindly took a punt on me.
I saw that your co-founder, Eric, he called programming, he said it's today's literacy. You have to have it.
It's today's literacy, and that strand runs through a lot of my career, but also runs through what we do at Cantab. Everybody programs. I myself have just spent the last 2 or 3 weeks programming up a piece of our infrastructure. There's no rest for the wicked, as they say.
But as I lay that foundation, as you talk about your background, it's going to look to the audience out there that there's this perfect physics mathematical background. But you're also a guy that you go to work at Goldman Sachs, and I've seen this mentioned in the press. You allowed yourself to turn up at a black tie dinner wearing a kilt.
Yeah, that's true.
But I'm curious, though. You're not a cavalier guy. Obviously, you're very grounded. You're very, you think in terms of risk. So, but what was your thinking there? What is your thought process that you allow yourself to stand out like that?
Truth is, of course, that for somebody who, like myself, originally came from Scotland, the traditional black tie dress is a kilt and all of the attendant bits and pieces with that. So it's not like I turned up in a clown costume.
I hope you did not infer that that's what I was saying.
No. I'm smiling as I'm saying this.
Okay.
But I do think that one thing that Goldman Sachs was very good at doing, and presumably still is it's tolerant to some degree of idiosyncrasy. Certainly in the early days, Goldman was a partnership with maybe 150 partners running their small businesses. That made it very much a meritocracy, very much a what have you done for me today kind of thing. Me turning up in a kilt is not the strangest thing that I've seen, but it's a place where really much more so than other banks, certainly in the 90s, it was a place where all Goldman was interested in were you good at your job? Within certain limits, obviously, turning up at in a clown costume at a client meeting would probably be a very quick way of getting fired.
I mean, I took it as a complete outsider reading about it in a press account. I just took it as you saying, look, I'm going to march to some music that is standard, but I'm going to think outside the box. I'm not going to just be the guy that's clocking in. I mean, that's as an outsider reading it, that's how one takes it.
I probably couldn't violently disagree with that view. No. I think yes. There's certainly some of that in me is to not just be the guy. Although to put this in context, Goldman Sachs, to take that as an example, Goldman Sachs is a very serious, very successful U.S. corporate, and there's a limit to how outside the box you can think in a bank, and quite rightly too. Banks are responsible for a lot of risk for their customers. They're responsible. They have a fiduciary duty in lots of cases. Yes, you can be a little bit idiosyncratic sometimes, but at the end of the day, it is a big U.S. corporate.
I want to break apart some of your strategy ideas and how your firm operates, but I wonder if you would be willing to paint a picture for me. I'm curious when I can look at the success of the London CTAs, the London quants, those many that have trend following backgrounds. Why did the switch happen? Why did London become the spot? For example, so many of the long-standing early pioneer trend following CTAs were from the US. What was the switch flip?
That's a good question. It's not one I immediately have an answer for, but I can speculate. I think if we think about the very early trend following, the history of the industry is the very early trend following, the turtles. We're talking mid 80s there, maybe early 90s. The kickoff for the London, or maybe better to call it the European scene, probably happened in the mid to late 90s with AHL, obviously, the granddaddy of us all, and then Winton and Blue Trend and Aspect and ourselves and a whole plethora of really great firms in Europe. I think partly the reason why we maybe managed to become more successful or grow was more of a scientific approach to investment and statistics. I look back at some of these things that I see in the old tattered books about average true range and breakouts, and it seems like the Dark Ages. We are thinking in a much more statistical sense, much more scientific, I think. And it's not just enough that it happens to have worked. Possibly that's, maybe we can thank David Harding and the rest of the team at AHL for building that into the consciousness, and then it just takes off. Why? So the question there is, so why didn't the CTAs in the US follow that lead? I would clearly believe that a more scientific approach to investing, a rigorous statistical approach to it, I clearly believe that that's better than just a rule that happens to have worked in the past. But it's not clear to me why that would then not be transplanted back. I remember, even though we started in 2006, 2007, I do remember people asking me, again, particularly in the States, why do you weight your positions by risk? Why don't you just take a constant lot quantity? 1 lot of this, or 10 lots of this, and 10 lots of that, and 10 lots of the next thing. And obviously that's, there's no other way. That's just madness in a world where you have a contract like the wheat contract, which is maybe, $20,000, and the nickel contract, which is $250,000. It's just an insane way of doing it. But it was the tradition, and our industry is quite conservative. The idea there's a small subset of investors who want the new thing, believe maybe that there's some fabulous technique out there that's just going to predict what the S&P is going to be tomorrow. But there are also people who want it to be the way it was, and anything that steps outside that is maybe a little bit different.
Fair enough. Let me jump into some issues that are near and dear to you, central to how you look at markets, your trading strategies. You're talking to clients and you have to tell the new client, and this could be a very experienced client, perhaps they're not experienced with your strategy yet. And you ultimately have to bring up the conversation of, hey, look, losses are statistically inevitable. You can't get around that fact. Now, there's still a significant number of people in the population out there, whether they're very astute about investing or not so astute, they still don't want to imagine losses as part of the game.
Yep, people are desperate to invest in something which never loses money. And that is, of course, why Bernard Madoff existed. There's a great phrase by John Maynard Keynes where he said, in the field of fraud and deception, demand creates its own supply. Everyone is desperate. Everyone is desperate to invest in something that doesn't lose money. I'd like to invest in things that don't lose money. I'd like to come up with a strategy that never loses money. Of course, we all want that. But the reality of almost all investing is that if you're really good and or really lucky and you've got a very long track record, maybe 20, 30 years, and you've never changed your strategy over that period, which of course none of these things are really true for anybody, maybe the best you can hope for is a Sharpe ratio of 0.8, 0.9, maybe 1. I know that there are some more liquid, say, stat arb strategies which can outperform that for a long period of time, and then, of course, August 2007 happens. But broadly, a good investment strategy, an outstanding investment strategy, is something which, over a long period of time, has a Sharpe ratio of 1. Investors should really want that. So, a 20% volatility with an average gross 20% return, that would be great. But that does mean something with, say, a 20% volatility. Every 2 years, it's going to have a drawdown of 15%, statistically. Every 4 years, it's going to have a drawdown of 20%. This is just what happens. Even if the system truly has that return profile, it's going to experience those kind of drawdowns, and it's going to experience losses. I have a little spreadsheet that I sometimes show to clients when I'm discussing this, which, and broadly we don't really use spreadsheets, but it's a nice little tool, which sort of simulates 5 years of returns, daily returns, from something which is a 20% return, 20% volatility process. So, effectively a Monte Carlo simulation, if you want to call it that. And every time you press F9 on this spreadsheet, it draws another graph of another realization of this random but positive process. You don't have to press F9 very often before you get a history which loses money in a straight line for 5 years, which has a 40% drawdown. And remember, this is something which is guaranteed to make 20% per annum over a long enough period. So the expectation of losses is something that everyone should build into their investment process at all times, and it's something that investors do. And the majority of our investors are institutions. They're pension funds, they're insurance companies, they're sovereign wealth funds, they're endowments. to be very fair to these investors, they are really quite sophisticated and they understand that. And so I think, if you're sometimes when you're speaking to maybe high net worth individuals or smaller family offices, the desire there to protect capital is much stronger. You have to be extremely clear about the fact that there are things that will happen in the future which will be unpleasant. The other thing you have to do is explain to investors when you're making money that it probably won't last.
Do you see the demand for that discretionary macro trader hedge fund that just says, trust me, I have the experience, I can call the direction, I can position these multiple futures contracts across all these different markets, just trust my discretion? Do you see the demand for that waning?
Obviously, by the time somebody's sitting on the other side of a table from me, they're probably not going to be asking me that question. And I am, of course, very clear about the fact, particularly when people say, well, do you take risk off? Do you put it on? How about taking off your bond position or adding more of this? I'm very clear about the fact that I cannot see into the future. I'm not psychic, so therefore I don't have any skill in that. That my skills lie elsewhere. There is an argument that, at least in terms of positioning longer term, maybe nobody has skills like that. Maybe it is just impossible. I could certainly argue both sides of that. I think the demand for discretionary trading probably comes from the reactive demand. It's extremely hard to write a model. Well, it's impossible to write a model that can react to every last move in the market or react to a piece of information that's coming in. I don't know. September the 11th is probably a very good example of a piece of information that arrived, the world changed at 9:02, and systematic models knew nothing about it, whereas discretionary traders clearly did. So in those kind of events, it's quite possible that discretionary traders will outperform, and I can understand why people have that demand for it. But it is an extremely difficult job to be a good macro trader, and we all know of those people who have great reputations in doing that, and it's maybe only a handful of people. Of course, the interesting thing about macro trading is that everyone wants to be a macro trader. It's really interesting when you hear stock pickers talk, discretionary equity long short people talk. Very often what they're talking about is macro things. We think the market's going up, we think it's going down, we're doing this, and then therefore we're going to buy these stocks. And quite often macro decisions are wrapped up in security analysis, which they probably shouldn't be. I really think trading macro on a discretionary basis is one of the world's hardest jobs, and it's possible that the people who are successful at it may just be the lucky pennies. I don't know. I don't have hugely strong views on this, but I think it is a very hard job.
So the macro discretionary guys, when they hear, and I'm just kind of painting an illustration, it could be the investors that are hearing from you for the first time, but the macro discretionary guys, when they hear that everything you do is systematic, from strategy selection, asset allocation, portfolio construction, position sizing, execution, and risk control, that everything you do at your firm is systematic, that's got to cause some people to just go, what the blank? How there's got to be that aha moment of like, hold on, this is an approach that's different.
I don't think we are exceptional. I think it's, obviously, whilst I know the people who run my peers well socially, I don't know what they do and how they sell themselves, but I would be surprised if any of the large European CTAs are talking about how they intervene in what they do and they make some decisions. Remember, one way to think about this problem is that, and there is that little bit from people where, well, we have a model, but we occasionally intervene. My view of that is not systematic trading. Systematic trading, I've used this phrase before, it's a little bit like being pregnant. You either are or you aren't. You can't just be a little bit systematic. I often say to people who, are maybe pitching me with systems that are a model that they then put a discretionary overlay on, I say, well, why don't you just run 2 books? Run the model in one book and run your discretionary overlay as another book, and then just see which one makes money. Once you think about it that way, the decisions, often this is a way for people to hide really quite complex decisions. Remember, the point, that what we're all trying to do is we're trying to say what's more likely to go up tomorrow and what's more likely to go down tomorrow. And that's the decision. Now, what we have, and many other people like us, is we have lots of complex, or sometimes simple, models which have been tested statistically over many, many years, and then they're weighted using very sophisticated weighting algorithms and cost control measures and all of those other things, literally millions of lines of code running. And all we're trying to do is forecast whether or not something's going to go up or down tomorrow. Very often people intervene in their models by saying things like, well, I think vol's going to come off tomorrow, or correlation's going to go up, or I don't think this model's going to work as well tomorrow. Now, that's a very complex statement. The amount of analysis you would have to do to say that, for example, a trend following model isn't working very well and is unlikely to work tomorrow, since it's so difficult to do that for something as simple as an asset, the idea that you can do it for something as complex as a model which is running on 120 different assets with various risk weighting and cost control measures on top of it seems to me to be unlikely.
Yeah, fair point. Fair point. Why don't you talk about part of your process under the hood, in the sense that you like the idea of prove a strategy is broken rather than it's right.
Yeah, I don't think I'm the first person to come up with that, in that, effectively that is the scientific method which has been working pretty well for humans since the Greeks came up with it. Science is about proving things wrong. Okay, it's not about proving things right. What you're trying to do is break your strategy. You can never really prove that a strategy works or doesn't work. Finance, despite pundits and newspapers and people on the television, and maybe even people on podcasts, filling what they say with certainty. This is going to happen. This is the best way of doing things. Our systems are better than somebody else's systems. Our stock portfolio is better than somebody else. I know this, I know that. Finance is full of all of that. But in fact, finance is dominated by randomness. Randomness is everything. And so, because randomness is everything, you need to be uncertain. You need to have a lack of conviction and dogma in certain things, because you want to be able to prove that things are wrong. And so, when we come up with a new strategy or a new idea or a new trading system, what we're trying to do is, at least in, when we're simulating it and running it through all of our systems, what we're trying to do is find out what's wrong with it. And then if you get what is literally months of testing and retesting and rethinking about it and thinking about things, different environments and so on, if it gets through months of that, then maybe it's going to work in the future. And these are all very weak, uncertain statements. But to a great extent, the philosophy of what we do is around that uncertainty and of conviction. There's certain things I've got conviction about. Obviously, I've got conviction about the importance of technology. I've got the conviction about the importance of risk weighting or coherent portfolio design. All of those things I've got a lot of conviction about. But I don't have a conviction about any particular technique. You just do what you think is best and what you think will be persistent.
Yes, I love the way of dealing with uncertainty, because it seems like until the last handful of years in the financial fund management arena, so many people desire certainty. And so it's refreshing. And of course, as you say, you're not the only one. It's refreshing to hear that I just don't know. I'm doing the best that I can, but I don't know, and I really don't think anyone else knows.
Yeah, there's a little phrase that I sometimes use, which is that systematic trading it's what we are trying to do as scientists in finance is a little bit like sort of dimly being able to forecast what the weather is going to be like tomorrow. And it's like meteorology in that sense. It's full of uncertainty, and technology helps, and the models aren't perfect, and they don't forecast better than even the biggest computers in the world don't forecast the weather very well 5 days forward. But meteorologists are trying hard to improve that, both on the technology side and better theories about atmospheric circulation. And they're maybe not too bad at forecasting the weather tomorrow in certain places. Probably not in the UK because it's so rainy, but you understand where we are. In the past, a lot of investment has really been people looking at the sky and saying, "Look at that cloud; it looks like a dog." I think our way, and people like us, our way of doing it, I think it's what we do. I think it probably captures the realism of the world. The other sort of way of thinking about this is when very often, and rightly, when something happens, either when you make money or lose money, or when a model does something or whatever it might be, there's always the question that everyone asks, whether or not it's internally, people at Cantab or our investors or journalists, why did this happen? It's a great question. Why did this happen? And what we try and do is approach the problem from the perspective of the reason why this happened was chance. Now prove that it wasn't chance. Very often that's quite hard. You have you have a bad month or you have a great month. People say, well, what happened? Say, well, can I prove that it's any different from chance? Quite often the answer to that question is no. But it's just a different mindset. And obviously you have to approach problems in lots of different ways. But approaching a problem from the mindset of, I think this might just be a result of random noise, let's see if we can prove that it isn't, it's intellectually satisfying, if nothing else. I think it's quite a powerful technique.
Let me ask something, I don't know, I'd really call it controversial, but I saw this great article that was about you, featured in the New York Times. And I kind of went through some of the comments, and I noticed some of the comments were highly negative, and the thrust of the comments were essentially that you don't bring value to the economy. And I thought to myself, because I know something about what you do and what your peers do, and I thought to myself, those comments misunderstand, because there's so many of your investors, even if they're institutional investors, are representing the small guy. I mean, it's the small guy's retirement money that often makes it into the big institutional account. And so I think it's unusual that maybe people don't see that, yes, you might not be accepting ma and pa's retail account. That's not your position. But I think someone misses the point and misses the boat when they make that criticism. What's your feeling on that?
This is a hard question to answer. So the question is, are we doing something that is socially useful? Are we doing a good thing for the economy? That's a hard question to answer. Once you start going down that route, what is useful to the economy, or useful to society? The world only needs one car manufacturer. It doesn't need hundreds of car manufacturers. It doesn't need hundreds of models. So every car manufacturer is kind of not doing something useful for the economy. Nobody really needs an expensive meal at an expensive restaurant. So expensive meals and expensive restaurants aren't really doing anything useful to the economy. Nobody needs podcasts. We can live without them. Once you get into that, then I think you're getting into sort of dangerous water. We are, I believe, over time, are providing something which is valuable to our investors. I think we are doing that as well as we can. We are constantly trying to add little incremental improvements that make the returns better. We won't make money every month, and we won't make money every year, and sometimes we'll lose money and sometimes we'll make money. But we are doing the best we can to produce positive returns for our investors. And our investors are, as you say, a wide variety of people. They're pension funds. It's as you say, mom and dad, as we say here in the UK, who are investing in this. And where I feel, although this is not quite the same as finding a cure for cancer, and it's certainly not the same as landing a probe on a comet, to use something recently, which are all fantastic things to do. This is what we do, and we probably, at the margin, make the returns of our investors' portfolios better in some way, either higher or lower risk or less correlated and so on. Where I think there's much more problem in people doing something which is not socially useful is when relatively simple strategies are dressed up as something very complex. People effectively just being an index tracker, doing long-only things, but just actually tracking the S&P index, but charging 2.20 for it. That's a very bad thing to do, I think. At least I believe that what we do is something that is intellectually rigorous. It's probably a good thing. The other thing to remember, of course, is that trend following, systematic trading, the money comes from somewhere. If we make money for our investors, somebody loses it.
And if you lose it, someone's gaining it.
Someone's gaining it. We would believe and hope that over time, we will make money more often than we lose, and that will, over time, give positive returns. But it doesn't mean that somebody is losing. And it's a very hard question to answer.
There's a game out there that everybody can play. Everyone can pony up to the table, and they can develop a strategy, and it is the ultimate game where everyone can try. And I'm not just being a homer trying to defend you from the comment, but I kind of look at it like, okay, you know what? And I'm not asking you to say this, but I can draw my conclusions about those types of critics. And it's like, hey, if you don't like it, go try. Ultimately, the libertarian in me is like, hey, I think we've got a lot of better things to do on this planet than draw those types of conclusions. And perhaps that if you look closely, you can see those positive things. But of course, we all know that some people will never see some positive things. So you can't convince everybody, right?
That's probably true. I'm obviously always wary about talking about politics in any public forum because it's not my job to do that. But, I do believe that we do a relatively good thing. We provide, if nothing else, I provide employment for 50 people in Cambridge, which is the small business side of what we do as well. And it's important to remember that, this little community that we have is an employer, and it pays people money and does all of those things as well. So I think, whether or not there's some great good out there that we all have to aim for, I do believe that, we run good small businesses, and that is a good thing. So I'm very pleased about the fact, and one of the things I'm very pleased about is that in 2006, Eric and I sat in a small office with 2 computers and a server that gave us electric shocks every time we touched it. And from that, we have built a business. It's a small business, and it's a business that, like any small business, can go through bad times and could potentially go bust. And all of the efforts associated with running small or medium-sized enterprises, we've managed to survive for 8 or 9 years now. And I'm really pleased about that. If I'm proud of anything, I'm proud of that.
Well, it's inspirational. It's inspirational. I would love you to expand on the idea, and I think I saw you say that you, unlike maybe peers or other firms out there, you like to ask clients what they like. Not necessarily force things on clients. If you could expand on that, because clearly some clients are not going to have the technical market know-how that you do. So there's going to be some desire for guidance. So maybe I'm taking a little bit of that out of context, but could you expand on the idea of seeking client feedback for what they want?
That's maybe taken a little bit out of context. I think it is important to understand what your client's utility function is, to use that scientific phrase. What are they looking for? What do they expect from an investment? And that sort of informs the way that you explain things to them. As you say, generally, although all of our clients are very knowledgeable and sophisticated in lots of different areas. And of course, they have to cover all types of investments and all types of asset allocation. They're almost certainly less knowledgeable than us in the very area that we do, systematic macro trading or systematic micro trading. So I'm struggling to remember that particular quote, but I think the point here is that you do have to understand your clients' drivers. What is it that they are looking for in their portfolio? What do they expect? And it isn't a question of us sort of sitting on one side of the table saying, what do you want? We've got it. You just ask, we'll give you that. But understanding what drives the decision-making process, who their stakeholders are. We, for example, we have two products. We have a original quantitative fund, which is higher volatility. It's 20%. It's higher octane. It's 2 and 20 fees. So it's very much in that mold of high octane, very diversified, systematic macro and micro trading. And we also have another product which is lower volatility. It's 10% volatility. It's much more scalable. It's got maybe just more basic trend and more basic value strategies in there, and it's available to investors at 0.5 and 10. Now, understanding your investor means that you can understand what their internal desires are. What do they need? If maybe they want a low-cost, very functional, but they want a low-cost system where it's lower volatility and therefore the headline numbers are smaller. We all know that if investing in a 20% volatility product is too risky, then all you have to do is invest half your money in the 20% volatility product and keep half of it in your pocket, and you've got a 10% volatility investment. But somehow that doesn't feel the same as a 10% volatility investment. For reasons that I really don't get. I mean, the pure mathematician in me says that's nuts. But nonetheless, it is true, and I'm human too, obviously, and I feel that. So I think it is important to understand your investor, who their stakeholders are, and by understanding that and communicating with investors at the right level for an investor. None of our investors needs to know or cares about the deep statistical details which might be embedded in some nonlinear Bayesian regression portfolio algorithm. And that sounds great, but they kind of don't care, and they shouldn't care about that. But they should care about things like culture, technology, people, research processes. And these are all things that we can explain and want to explain in great detail. And if you can understand what your investor needs and wants, then maybe you can explain those things better. I always feel that I'm not really in that camp of, and our industry is quite bad at this, the industry of, if I told you about my models, I'd have to shoot you. That's quite common, that sort of, I have to be massively secret, can't tell you about it thing. I think that's wrong. We as an industry are managing money for people, and it's their money, and they have the right to know, and we have the obligation to tell them what it is we're doing with it.
Yeah, fair point. And I think that probably has been one of the reasons that you guys have gone from zero to significant in fairly short order in a very competitive space.
Yes, we have. We were. I'll refer you to my previous thing about randomness. Some of that is, of course, luck. We had a good run. We didn't have such a good year last year. We're having a good year this year. These things. Some of this is randomness. But actually, apart from being open and transparent and supportive of investors and all of those things that you have to be, I think the other strand that runs through everything we do is that sort of aggregation of marginal improvements. Little small marginal improvements that really, in of themselves, maybe just don't make much of a difference. Let's say, I don't know, we work out some way of saving ourselves 0.5 basis points in costs a day. That doesn't seem like very much. 0.5 basis point, that's a tiny amount of money. But it adds up to nearly 1.5% over the course of a year. That's great, right? We'll have that. And lots of those little marginal improvements are probably what distinguishes good funds from less good funds.
Ewan, where can we send people? People can go find more about you and your firm, Cantab Capital, online. That's easy enough. And if I'm not mistaken, I think I saw you somewhere on Twitter as well, yes?
I think I don't really tweet anything about finance at all. It's not, I don't think it's the format of 140 characters is not really ideal for extensive thought and analysis of things. But our website's a great place to find out a lot more about the firm. All of the contact details are there, and that really I actually quite like our website. I think it gives a very good impression of the firm and how we work and our culture and the products that we have. So yeah, the website's a really good place to find out about Cantab. And obviously if any of your listeners are in Cambridge, I'm more than happy to just drop in and see us.
Ewan, hey, my pleasure. Thanks for coming on today. I hope some of my questions were not too far out from left field, right field. I hope you seem to handle everything with aplomb and very smooth and diplomatically. So the one though about the guy that was the critic, he actually annoyed me more than anything because I was like, I just want to strangle him. But
one of the things you have to remember in life is that not everybody's going to think that you're great.
Yeah,
and there are valid criticisms. I'm quite phlegmatic about these things. There's valid criticisms about systematic trading. There's valid criticisms about the finance industry, and just getting annoyed about it doesn't help. You've got to take those criticisms on board, understand why they've happened. There's been a lot of, as we know, and lots of stuff in the press about bad things that have happened in finance. Sure. People are right to criticize. I'm not going to get annoyed about it because maybe some of the criticisms are valid. We certainly don't have a monopoly on the truth.
No, but as somebody who's watched this particular space for a long time and going back many, many decades, I think there is something noble about the systematic guys that have done this for a long time. I think there's something, as you talk about the bad things in the finance space, the Madoffs of the world, or a particular strategy that blew up that wasn't so great, there is something generally consistent that you can kind of hang on to in this systematic space. Like you said, though, maybe things break and it all falls apart at some point in time, but knock on wood, for several decades or more, it's done pretty well.
I think you can probably summarize it as, I think people in the systematic space, we try harder. To use that old Davis ad, we do try. I know just about everyone in the European space. I know that everyone is completely focused on just doing the best thing they can, and I think that's great. There's very few. Well, I've certainly never met any sort of charlatans or people that are just knocking together any old rubbish just so that they can raise some assets. People try really hard, and sometimes we fail, but on average, I think the industry succeeds. And the industry's been in the doldrums for 2 or 3 years. There's been trend following in particular hasn't performed very well for probably the last 3 years. It's performing very well in the last 3 months.
That's how it goes, though, right? It's it's not necessarily consistency. It can just come boom, and you all of a sudden have a September of 2014, and everyone goes, "Where'd that come from?" And you're like, "Hold on, that's trend following."
That's the way it works. That's an interesting thing for people. I explain. When people say trend following hasn't worked for 3 years, if you take a simple trend following model and just run it across 100 assets, when trend following is working really well, it's maybe working on 60 assets and not working on 40. And when it's not working, it's working on 45 assets and not working on 55 assets. So there's never really been a period in history where trend following hasn't worked on something. It just hasn't worked on enough. And now, of course, we're in a situation where, and I've got to be careful always to say, we're not a trend follower alone. We do lots of other stuff. But, trends in bonds, trends in ags, trends in the yen, trends in energy. I mean, this is all working out really well, and we're in one of those golden periods where trends are working on quite a lot of different things. That too won't last. Over time, there'll be ups and downs. But over a long enough period of time, trend following and more generally systematic macro trading has done incredibly well. And presumably, and this is the little scientist and uncertainty in me coming out, and presumably with a reasonable degree of probability, it will continue to work in the future.
Hey, look, if anyone out there looks at a systematic quant track record and it's all black ink, then you've got trouble.
I refer you to my previous answer about Bernard Madoff.
Yeah. Hey, Ewan, it was a pleasure having you on today. Thank you for providing some great insights and experience to my audience.
It was my pleasure, Michael. Thank you very much.
Thank you. Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.